So talk me through this. As we're going into what potentially could be a rate cutting cycle, I think a lot of people expect it to be a rate cutting cycle. You say the build out of commercial real estate is actually slowing down, and that's good for the sector. This is confusing a bit. Explain this one to us.
Well, first of all, this is a positive step in a progression of things that's happened. The passage of the tax bill was very positive. A little bit of clarity on tariffs is positive. The pullback we're talking about is on construction of new buildings.
But why would it slow down as we go into a rate cutting cycle?
Because equity for development has been very, very cautious, and they've pulled out of the market for the last 2.5 years, and they're not ready to come back in yet. They want to see prices settle. They want to see demand hold up before they start the next building cycle. And where we're seeing this is the most pronounced is multifamily. There's been record production of new units that's pulling back significantly. Retail and office haven't had a supply problem. It's been a demand change in the last 10 years for retail and 5 years for office. So those property types aren't overbuilt by any stretch of the imagination because of new construction. Nonetheless, when you see this much of a pullback in any new starts, industrial properties, warehouse distribution space, also had some overbuilding, which is now being corrected because of the pullback in new development.
All right. So you say that's good for yield or cap rate, as you say in your business. It's supportive of yield because if there's not more units coming online, which oftentimes I would think would be more attractive. It's a brand new building with new amenities that helps support the pricing of the existing building.
That's exactly right. Occupancies go up for existing buildings. There's less competition. Rents go up and so on.
All right. Talk to me about return to office, because it's two forces here. There's return to office, which we've seen a lot more companies. They want their employees back in the office. But at the same time, we see people reducing their workforces. Now, it's not dramatic, but we have seen it in a number of big companies. So how does that equilibrium play out when it comes to cap rate, yields, and also demand for new buildings?
Office is in a universe by itself because of the post-pandemic issues that we've seen. So it's very different than all the other property types because of that. Within that, what we're seeing is a volume of daily attendance back up to 80% of what it was pre-pandemic. A year ago, it was less than 70%. 2 years ago, it was less than 60%. So that progression of more companies demanding workers to come back is a hugely positive force. You're right, the labor market is slowing. Professional jobs have actually slowed down dramatically in the last 12 months. So the fresh demand isn't being created as much, but the existing workers are being asked to come back into the office space. That's the most important thing because as the leases roll over, you're now looking at your daily occupancy in terms of your future demand for renewing a lease. And that is why that factor is fairly positive. But demand for office space will never be the same because of the pandemic and all the new ways companies are looking to cut costs, mine included. So I think it's going to be another 2 to 4 years of some pain for office buildings. But Frank, it's a huge difference between older Class B and C, less amenity-driven properties than newer, more modern, and especially suburban office properties. Those vacancies are 11.5%. The older product is 30 to 40% vacant.
Yeah, we talked about that bifurcation before.
Yes.
I want to talk to you about the future of commercial real estate, multifamily. We were very lucky to have a great guest on, the CEO of Campus Apartments, talk to us about campus housing. A lot of growth there, very stable revenues. But he really said it was kind of tied to big and especially public universities and high-profile universities like a Harvard, a Penn, et cetera. That's where students want to go. So that real estate continues to see strong demand. What other areas of commercial real estate are seeing strong demand outside of campus housing? I did a story actually a couple years ago about experiential retail, like malls that have aquariums and zoos and things like that. Give us some insight in the public or private markets, because we have the audience that kind of invest in both. Where is the future of commercial real estate going?
You and I spoke about data centers not too long ago. And,
but everybody talks about data centers.
Everybody does. But it's a booming industry, but it's a fairly shallow industry because of its specialty. I think your experiential retail comment is probably the most relatable trend in that the comeback of retail real estate right now is most in demand in the industry.
Really?
Because of 15 years of repositioning, getting rid of obsolete shopping centers, and renewing the rent roll with companies that have both an online presence and a physical brick and mortar presence. Retail has come back very strongly because of the experiential factor that brings a footprint to the shopping centers. The pandemic, interestingly enough, work from home created demand at coffee shops and nearby retail because people need to get out of the house and go hang out somewhere to work. That is completely unexpected. And this is where commercial real estate always morphs with the economy. And I think multifamily rentals are projected to be very strong because of the fact that people can't afford to buy homes.
Right.
Home prices are sticky. And we've seen the affordability gap between renting and owning at an all-time high.